Hello, my name is Dennis Brooks. I'm a graduate student here at the UAB Colott School of Business, and today we're going to discuss Chapter 21 in Accounting 201, which is Flexible Budgets and Standard Costs. We're going to start out with First, we're going to start out with how you can reach us. You can reach us at Colott's Tutor Lab at uab.edu. Or you can reach us on Skype at Colott space Tutor Lab, one word, Tutor Lab. And you can reach us there on Skype for Skype sessions if you wish. Again, like I discussed, we're going to discuss Chapter 21, Flexible Budgets and Standard Costs. Budgetary control refers to management's usage of budgets to monitor and control a company's operations. Budget reports contains relevant information that compares actual results to planned results. Process budgetary control. Develop a budget, compare actual results to budget, change budget, and take action, and then set new plans. Now what this would be is you develop your budget, compare your actual results. Well, maybe you don't like your actual results, so then you would change it and start your new action plan, and then you would set new plans for it. Now, what if you liked it? You wouldn't worry about these steps. If you liked the results you were getting, you wouldn't change them. One of the purposes of using a budget to compare actual to budgeted activity is to compare whether you are having a favorable or unfavorable variances. A favorable variance, when compared to budget, the actual cost of revenue contributes to a higher income. An unfavorable variance, when compared to budget, the actual cost of revenue contributes to a lower income. That seems fairly easy to understand. Favorable, unfavorable. Flexible variable budget is a report based on predicted amounts of revenue and expenses corresponding to the actual output level. For example, at 10,000 units, you would make X amount. At 12,000 units, you would make X plus the additional amount, etc., etc., etc. Flexible budget performance report lists differences between actual performance and budgeted performance based on actual sales volume or other activity level. Management by exception means that managers focus attention on the most significant differences between actual cost and standard cost, especially useful when directed at controllable items, enabling top management to affect the actions of lower level managers responsible for the company's revenues and costs. You have a cost variance or variance. It is the difference between actual and standard cost. Cost variance analysis is a flow of events that occurs when management compares actual events against the standards. Prepare a standard cost performance report. Compute and analyze the variances. Identify questions and their explanations. They may have reasonable explanations or they may not have reasonable explanations. Like we talked about in Chapter 20, it's really important when you're doing these budgets that you're doing this with the participation of the people that you're expecting to affect the outcome of that budget, which, if you remember, we called participatory budgeting. But anyways, take corrective and strategic actions that if you weren't satisfied with your performance here, take corrective and strategic actions and remonitor the situation. It's kind of management 101. Okay, so we're going to go over here to the Excel program I've got up, and I'm going to explain a couple of things here. Cost variance in this will equal CV. Actual cost equals AC. Actual price, AP. Actual quantity, AQ. Standard cost, SC. Standard price, SP. Standard quantity, SQ. Now, in each of these, you see numbers. In this, I'm just going to say I'm creating surfboards. And it normally costs me a $20 piece of wood it normally costs me a $14 piece of wood to make a surfboard. But in this instance, it actually took me 20. I had budgeted that I was going to sell 1,000. Well, I only sold 800. So now we got to figure out where the variances in it are. And I show them here, but I'm going to discuss them over here, and then I have down whether they're favorable and unfavorable. And then I'm going to go back to chapter 20 and go through that budget and explain why those were favorable and unfavorable. So we're going to slide this over a little bit. Okay. Cost variance equals actual cost minus standard cost. The actual cost was $16,000, remember? And the standard cost was $14,000 because that was 800 units at $20. Remember me talking about the monetary difference on that. And then over here for the 14, it's 1,000 units at 1,400. That's what I did budget. Now, to find out how these are, whether they're favorable, unfavorable, we then compare the results. We take the actual quantity sold, multiply it times the standard price, and we would have had not a great month, but at least we would have kept within the $14 per board budget. But we would have had 11,200. But going with what we sold, 800 units at $20, so we had a $4,800 variance there. Now, 16,000 minus 11,200 gives us that 4,800, and that tells us that is an unfavorable variance. Okay, so we go over here to our standard quantity times our standard price, which would give us the normal 14,000. Now we take again, what we're comparing it to, 11,200, subtract 14,000, that gives us minus 2,800. That's actually a favorable quantity variance. If we had sold 1,000 units at $14, would have done a lot better than this 14,000 here. We would have done 16,000. So we would have had a favorable variance here, an unfavorable variance there. You subtract these two to find out what the total direct materials variance is. And that's $2,000 unfavorable because we budgeted for, let's see, we budgeted for 14 and we spent 16. So we overspent by $2,000 because that's cost, our cost. That's not the customer's cost. This is our cost. And I'm going to go over here to chapter 20 where I had talked about this earlier. And I was going through, we budgeted $695 for net sales. We made $785. That contributes to net income. So $90,000 favorable variance. We budgeted $500,000. We spent $550,000. $50,000 difference. That is an unfavorable variance because that takes away from the bottom line. Because that's our cost of goods sold increased. That takes away from net income. So we go down here and we budgeted $60,000 for sales salaries. We actually spent $62,500. That is an unfavorable variance of $2,500. We budgeted advertising of $50,000. We only spent $48,000. That is a favorable variance because it goes to the bottom line of net income. We predicted we would use $1,800 in store supplies. We only used $1,500. That would be a $300 variance. So as you go down and look at these, you see how they contribute here to net income, and you decide whether it was a favorable or an unfavorable. This, unfavorable. This unfavorable. Neutral, neutral, neutral. Neutral, favorable, favorable, unfavorable. Favorable, unfavorable, favorable. So that's what you should take from this when you're talking about actual budget and variance, which we've discussed here. And that's what you should take away from this, is what the differences are in. You can have variances in your labor hours, you can have variance in your costs, you can have variances in your fixed costs for a variety of reasons. The important thing to remember here is, which way does it affect the bottom line? If it adds to net income, it is a favorable variance. If it takes away from net income, it is an unfavorable variance. So this will conclude chapter 21. And again, my name is Dennis Brooks. I'm a graduate student here at UAB Colott School of Business. You can reach us at Colott School of Business. I'm sorry, Colott. Sorry, excuse me. You can reach me at, or any other tutor here at Colott Tutor Lab at uab.edu, or you can reach us on Skype at Colott Space Tutor Lab.